Good afternoon and welcome to this latest and last in the current series of webinars that Eurodad and our partners have been organising on debt issues in the context of the COVID-19 crisis. Our topic for today, as you'll know, is debt sustainability in the post-COVID-19 era, as we face the biggest setback to development efforts in over a century. We know that financial pressures are arising from lower economic growth and higher debts, which are dramatically shrinking the available fiscal space to support the achievement of the 2030 agenda, and debt relief efforts have to take this into consideration in our view. So today we'll be discussing the role of debt sustainability methodologies in achieving the dual goals of long-term development and financial sustainability. Before we kick off, a little bit of housekeeping. We're aiming to run for about the next 90 minutes. Interpretation from and to Spanish is available. If you look at the bottom of your screen, you should have a globe there, and you can switch to Spanish or English channel. We kindly ask you to post any questions that you have in the dedicated Q&A box. You'll see again the option Q&A at the bottom of your screen. We'll try to use the chat space, the specific chat function, principally if any of you are experiencing any technical issues or have additional comments or information that you want to share. Saying that, we hope to be able to have as active a participation as possible from all of you, and we really thank you for joining us this afternoon. We know there's a lot of different webinars happening actually even today, and for no doubt you're all suffering a bit from Zoom overload. So first of all, to introduce our esteemed panelists for today, we've got a great lineup of speakers who've agreed to share their expertise with us. First up is Eurodad's very own Daniel Munavar. He'll be sharing ideas on how to balance debt sustainability with SDG financing. Daniel, as many of you will know, is a senior policy and advocacy officer working on debt justice here at Eurodad. He's interested in the analysis of the links between debt sustainability and the 2030 agenda. Before joining Eurodad in 2020, Daniel worked for the United Nations Conference on Trade and Development, UNCTAD, and advised the Ministries of Finance of Colombia and Greece on debt-related issues. Daniel holds a master's degree in public policy from the University of Texas in Austin. Secondly, we'll hear from Christina Lascaridis, who will be sharing with us a brief history of the IMF debt sustainability assessments and considerations of its limitations in periods of uncertainty. Christina is a PhD candidate in economics at SOAS, University of London, and is working on debt crisis resolution with an emphasis on the World Bank and the IMF. Christina was a research fellow at Duke University's Center for the History of Political Economy, and she co-convenes the Politics of Economics seminar series at the University of Cambridge. And last but not least, we have Dalia Hakura, who will be speaking on the role of the IMF low-income country debt sustainability framework in program design and the challenges posed on its implementation by the crisis. Dalia is a Deputy Division Chief in the Debt Policy Division of the IMF's Strategy, Policy and Review Department, and she's currently working on issues pertaining to debt analysis and debt policy. Since joining the IMF, she's worked on a range of emerging market and low-income countries and was a mission chief for Burkina Faso and the Republic of Congo. She's published extensively on various macroeconomic issues, including in various IMF Sub-Saharan Africa, Regional Economic Outlook and World Economic Outlook publications. A great lineup for you this afternoon, and we look forward to the discussion ahead. To kick it off, let me just start with a brief introduction to the issue. Sustainable debt is an important element of sound macroeconomic policy, and assessing sustainability is an important means to gauge sovereign debt vulnerabilities and potentially provide an early warning concerning fiscal policy. Debt sustainability assessments, or DSAs, have thus become a standard instrument in economic surveillance and also as a tool for taking decisions about the provision of financial support in times of crisis. Most notable, the assessments carried out by the IMF under the IMF World Bank Debt Sustainability Framework, which we'll be looking at a lot in detail today, and which play a key role in guiding creditors' lending decisions to low and middle-income countries, and essential to this current system in how debt crises are prevented and resolved. Yet the concept of debt sustainability itself and how to measure it remain issues for debate. What is accepted is that assessing debt sustainability is a complex and challenging task, and generally relies upon a combination of technical analysis and political judgment. The balance between these two dimensions will vary greatly depending, for example, upon when a debt sustainability assessment is actually done. For example, if we're talking about a time of crisis or in so-called normal times. And this also highlights a key challenge for DSAs in distinguishing between whether a country is dealing with short-term liquidity concerns or longer-term solvency issues. This in turn points to the important dimension of uncertainty, which we'll be looking at later when we consider DSAs, as they generally rely on assumptions about macroeconomic variables such as growth rates, primary balances, and interest rates. The validity of a DSA is therefore heavily reliant on what those underlying assumptions are. Now today, as we're facing an unprecedented moment of global economic uncertainty, with the COVID-19 crisis driving over 100 countries to seek emergency assistance from the IMF amid serious liquidity pressures. For many countries, urgent assistance will not be enough. They will need to move on to full IMF programs. But debt restructurings and substantial debt relief, including cancellation, which match the true nature of a country's vulnerability, will also be essential if we are to ensure sustainable and inclusive recoveries from the crisis that support efforts to pursue the SDGs and build climate resilience. The current approaches to debt sustainability up to the job? IMF DSAs will be a critical component as they guide decision-making over whether a state qualifies for a loan. They help to establish a financing gap that determines the size of any loan and the design of conditionalities in an IMF adjustment program, particularly on borrowing limits. Essentially, they play a critical role in determining who is going to shoulder the burden for resolving a crisis, whether creditors or populations. Now, since its introduction in 2005, civil society have pointed to substantive problems with the approach used in the IMF World Bank Debt Sustainability Framework, particularly its disconnect from debt relief and its focus on sustainability in terms of how repayable debt is, and rating risks in terms of the likelihood of default, without considering the impact debt levels have on a country's ability to safeguard the rights and needs of its citizens. Given that debt sustainability is the responsibility both of lenders and borrowers, the question is, when using this narrow approach, for whom is debt sustainable? Civil society organizations have long stressed the importance of widening approaches to debt sustainability, given the important role that the concept plays, both in ensuring debt vulnerabilities are dealt with in a timely manner, but also to ensure a fairer burden sharing of the costs of debt crisis. So this will be at the heart of today's discussion. So without further ado, let me hand over to my colleague Daniel, who will share ideas on how to balance debt sustainability with SDG financing.
Can everybody hear me?
Yes, I can
okay.
hear you well. Yeah.
Okay, good afternoon. So thanks, Mark, for putting together this this webinar. So building on the points raised by Mark, I want to talk about what that sustainability in the post-COVID era should mean. So basically, I want to use this 15 minutes to bring a couple of key messages. The first one is that debt sustainability analysis are a useful tool for short-term financial planning, because it allows policymakers to address, to look at their revenue sources, their expenditure requirements, and their financing constraints in order to develop consistent fiscal policies. The problem is that it presents limitation as a tool for the design of long-term development policies. In the current context, we're talking about COVID-19 recovery needs, the 2030 Agenda, and the Paris Climate Agreement. And the reason for this is that in a DSA, creditor claims take precedence over domestic expenditure claims. This means that in many cases, the sacrifice of the active pursuit of long-term development goals. So in the current context, we need to redefine debt sustainability, not as a goal per se, but relative to the post-COVID-19 development finance requirements. So to start, because I assume many people in the audience might not be aware what a debt sustainability analysis is, basically debt sustainability analysis, and this is the definition used by the IMF, is a standardized framework that is designed to assess the risk of debt distress that takes into account the capacity to carry debt and its capacity to carry debt, and how this is designed. And I know Dalia will expand on this, so I will not go into detail. Basically, a normal DSA or a standard DSA starts with the development of a baseline macroeconomic scenario, upon which you make a series of assumptions on the evolution of public revenues and expenditures. You take into account the structure of debt of the public sector on the one hand, and of the country as a whole on the other. And then you look at a series of financing options, and you add these different components, and that this basically gives you the projected evolution of debt. This is a very simplified version of how debt sustainability analysis is conducted. Throughout time, basically since during the last 20 years, the IMF has conducted a significant volume of research, developing a series of thresholds that allow the staff to identify when a debt is sustainable and when it isn't. Now, the problem with the DSA is that it carries an original sin, if you will. And to understand what that original sin is, you need to go back all the way to the 1950s and 1960s to the origins of how this tool was developed. So the origin of the DSA was in the context of the Marshall Plan, where in the late 1940s and early 1950s, the focus was on mobilizing large amounts of external financing to countries in need, initially mostly European countries, but then countries in Latin America, Africa, and Asia, rather than repayment capacity. So in this first stage in the 1950s, there wasn't a significant amount of concern of how countries could repay the financing that they were receiving from external sources. As a matter of fact, the entire premise of the UN development decade in the 1950s was to identify the requirements of the external financing that a country required in order to meet a specific GDP per capita growth goals. But then this started to shift in the late 1950s and early 1960s when a series of debt servicing difficulties started to develop in Latin America, namely Argentina. So you can see 60 years after, things haven't changed that much. And this led the staff of the World Bank to start working on the development of the first applied DSA. And the first definition that can be found in the literature of what debt sustainability is was provided in 1961 by an economist working at the World Bank that specifies that the fulfillment of debt service obligation is dependent on the economic capacity to adjust the claims on total resources, savings, and foreign exchange in any given year and over time, so as to release the amount required for that service. This, in practical terms, or in more simple terms, were basically meant that debt sustainability was defined as a situation where the country is willing or unwilling to adjust domestic expenditures to meet foreign claims. And as Alter highlighted in its original assessment, this can occur because a conflict with the objectives of relative full employment, accelerated economic development, more equitable distribution, and so forth. And this problem remains to this days, is that debt sustainability continues to be defined as to the extent in which governments are willing and able to sacrifice domestic objectives to meet foreign claims. Now, it's clear in the current context, when you think what those domestic objectives might mean in the post-COVID era, this is quite troubling, because it literally means that countries must choose between meeting the claims, meeting the payments on external debt service, or investing more in their health service to tackle the pandemic. So the problem is that this framework, as UNCTAD highlighted a couple of years ago, locks countries on a low debt, low investment scenarios, where because debt sustainability, defined as the capacity to meet private credit, foreign creditor claims, is emphasized, then countries don't invest enough in their development needs. So how we frame a problem it matters a lot. So it's clear that we need to shift from this framework that prioritizes creditor claims from one that places development financing requirements on an equal footing to debt service obligations. In 2005, the UN Secretary General proposed an alternative definition of debt sustainability that tried to achieve this goal. And in this report, he defines that debt sustainability is the level of debt that allows a country to achieve the Millennium Development Goals and reach, in that time, 2015, without an increase in debt ratios. So this is a good framing to develop an alternative assessment where we focus on the SDGs and on the financing development needs as a starting point in analysis, and then we assess the conditions that are required to meet that sustainability in the context proposed by the UN Secretary General, back then Kofi Annan. So last year, UNCTAD developed a DSA SDG assessment tool along these lines, where basically, if you look at traditional DSA framework, you look at the DSA, the focus is placed on debt sustainability, and the basic model output is what is the budget balance given the macroeconomic context that is consistent with debt sustainability using the defined thresholds of the IMF. The work that UNCTAD developed shifts this equation around and then places the focus on SDGs and debt sustainability. And basically you end up with a model that allows you to look at how the required investments in the development agenda evolve over time, how can the mobilization of domestic resources can support this investment requires, and what are the conditions and volumes of external financing that are required to meet these goals on a consistent basis. So right now, Eurodad is working along those lines to put forward a debt relief and sustainability proposal. The idea behind this is precisely to find a balance between the traditional concerns on debt sustainability, meeting private external creditor claims on the one hand, and meeting the development goals on the other hand. This model is developed on the basis of the UNCTAD model on the one hand, and on the IMF DSA on the other. And this is based on the notion that a successful recovery from COVID-19 will require a new approach on that sustainability. If we keep using the same approach that we have been using until now, we'll probably end up in a situation where a significant number of developing countries will either end on a debt overhang, meaning that they will have significantly high levels of public debt that will constrain them in their ability to raise additional financing and invest in their development requirements, or outright debt distress. So the guiding principles of this proposal that Eurodad is currently drafting is, number one, the emphasis on domestic ownership, basically putting the onus on on countries, on governments and local constituencies and CSO to identify their capacity to raise domestic revenues, to prioritize which areas they consider most important to finance, and how to ensure that debt relief is granted on the basis of these financing needs. The other principles that we think that guide the proposals is the need for accountability, not only to domestic audiences, but also to donors and constituencies in donor countries. That is fair both to domestic populations on the one hand, but also to creditors. That is transparency in terms of identifying where the resources are being used and for what purpose, and that is sustainable over the long run, in order to avoid a situation where debt relief is provided now only to find ourselves in a situation where 10, 15 years down the road, we see the same problems popping all over again. So the debt relief strategy that is being put forward by Eurodad basically has 4 components. One, it's a domestic revenue strategy that aims to develop a progressive and equitable mobilization of domestic resources, putting emphasis on areas such as tackling illicit financial flows, better mobilization of natural resources related revenues, and an overall progressive tax structure in developing countries. On a second step, to identify what are the public investments that need to be prioritized in order to ensure an equitable and fast recovery from COVID-19, but also that allow countries to meet the long-term goals of the 2030 Agenda and the Paris Climate Agreements. The third part is basically to assess what are the financing conditions that are consistent with this agenda and meeting that sustainability. And fourth and last, to ensure that debt relief is estimated not on the basis of how much a country can adjust in order to meet its its external creditors, but rather that debt relief is required taking into account the financing needs that are identified through this model. So we hope to have the draft out very soon, and to start working on it and show how it would apply to different countries, as the proposal is linked to the current G20 DSSI and also to the current financing arrangement provided by the IMF and the World Bank. So thank you very much. If you have any comments or questions, this is my contact details. Thank you.
Thanks so much, Daniel, for that great presentation and for kicking off the discussion this afternoon. Now we'll move to Christina, who'll be sharing with us some background on the DSA and uncertainty. Over to you, Christina.
Can you hear me okay?
Yeah.
Okay, I'm just going to try and share the screen and start the presentation. So hopefully that's all there. Okay, so yeah, a really successful series here. I'm going to cover some of the difficulties of conducting sustainability assessments, but also in very difficult times. And I'm going to, things that have already been raised in the area. So I'm going to start by just a quote from the pre-pandemic period, which was really by leading scholars in the field about not just the state of the art of assessments, but also the actual art. that's involved in assessing sustainability. Which debt turns bad, where debt becomes unsustainable, is frustratingly hard to find. In fact, it boils down to a mere judgment involved by multiple methodologies. So that's really important. There's many ways to do it, and that involves a political judgment about it. And why is that? Well, the future is unknowable, they say. As such, sustainability is because you would have hoped.
Sorry, Christina, we're having a little bit of trouble hearing you. So I'm wondering whether perhaps we should see whether Daniel can project your slides, and maybe that will help your connection. Perhaps you could, if you stop sharing your screen, Christina.
Yeah.
Apologies to the attendees. We'll just try and fix some of these connection problems. And perhaps, I think, Daniel, you were ready to project the slides, were you, on Christina's behalf? Great, and hopefully that should solve things, Christina. If not, then we'll try and find another solution. Carry on, sorry to interrupt you.
No, that's okay. Can you hear me now?
Yep, that seems to be good.
Apologies. Let me know, and it might help if I disconnect, connect. I don't know if that would be helpful, but let's see how it goes. What I was kind of indicating to you, the field of like in the exercise, AMR, but also.
Sorry, it's still. It just seems to be as soon as you want to talk about the presentation, the sound goes.
Oh, let me disconnect and reconnect. And apologies to all attendees. I think it might help things.
Okay, we'll give Christina a couple of seconds. If that's taking too long, then we may move directly to Dalia. If you bear with us for a minute or so.
And that's infrastructure in the middle of London.
No comment. Okay. Given that this.
Okay, I think Christina has connected.
Okay, it seems to be taking a little bit of time. I think Christina may have connected as a participant now. Okay, just for the comfort of the audience, maybe Dalia, would you be ready to do your presentation now, and then we'll just.
Sure, that's fine with me. That's okay.
Okay.
Oh, Christina's back.
Christina's back now. Okay, yeah. Great. Sorry. Okay, we'll revert back to Christina.
Sorry, can I just ask if that? Can you hear me better?
Yeah. It was very strange. It was working until you started presenting. So,
okay.
Let's.
I think this Zoom culture world, we still have a lot to learn about it. So I apologize for the for the disruption. So I just want to kind of move on from this point to just say that in the best of times, this is a very difficult exercise, and one of the reasons for this, if we can go to the next slide, is that DSA has sort of been caught between two two kind of contradictory and conflicting issues. One is moving goalposts about what sustainability is, and the second one is the greater ambitions that have been placed on what one would like debt sustainability analysis to do, along the lines of what Daniel mentioned previously. And if we look at the sort of very long-standing efforts to try and identify critical values after which sort of debt becomes bad, it's a very, there's very little consensus. And in fact, those goalposts have shifted. And this is just a small episode for the run-up to the HIPC framework. But this effort started from USAID in the 60s and from predictive models from way back. And at the same time, sort of there has been, precisely because of the narrowness of this approach, which is really about repayability in a very narrow sense, there have been long-standing attempts to incorporate debt sustainability as part of a much bigger understanding, in terms of long-term development targets, along the lines of what is the financing that's required and on what terms in order to meet the target, whether it was of the first development decades, but also now the subsequent development goals that are set, but also in terms of allocating minimum spending, human needs approach, human rights, or soft law principles in DSAs. So just to provide, with those opening remarks, a sort of a little overview of what I'm hoping to cover here. The one is some of the difficulties that are involved in making these assessments during the crisis in particular, some of the proposals for alternatives that have been put on the table. And I'm going to draw from history to sort of, contextualize some of these difficulties. So if we can go to the next slide. The kind of approach so far has been kind of characterized by the rapid upscale of IMF financing, coupled with debt service relief that it has provided, and the G20 DSSI debt service suspension initiative on bilateral creditors. And it has been broadly recognized that those won't be quite sufficient, at least not for all countries. And I just want to highlight here that there has been a great upscaling of approved financing across regions, and in particular on the right-hand side here, the two facilities that come with low conditions and can be rapidly dispersed. But there is no doubt that most high condition, longer term programs will also increase. So besides what, I think there was a seminar on this a few weeks previously, this has basically highlighted there's just not enough low condition, no debt financing available for balance of payments problems, which is why reliance on loan financing is so important. But I think what I want to highlight is the implications for sustainability that this kind of thing has. And so if we go to the next slide, one of the implications for debt sustainability is, I've just tried to indicate here how the dispersed financing compares to debt service relief that's due. And that's, we can see on the blue dot here, a selection of countries which have reached 100% of quota on those rapid facilities, the dispersed financing that has taken place, and how that compares to the debt services that is due on the creditors which are not eligible for the DSSI, so non-official debt service for this year and next. And the conclusions I want to sort of, the points I want to draw from this is that the scale of financing is far less than upcoming debt service payments due. The IMF loans will enable, and I think there are many people trying to kind of make this point, enable as many times before the diversion of needed resources to the repayment of other creditors. And I think the other point that sort of deserves some mention is that this sort of changes the composition of what a country's debt profile looks like, and sort of increases the component, which is very hard to restructure because of the IMF senior preferred creditor status. And also to sort of draw on like a lot of empirical evidence that suggests that waiting brings upon a deeper restructuring later on. And if we can go to just the next slide as well. A lot of the financing that is being approved is going to countries which have, through the DSF framework, been assessed as being at high or moderate risk of debt distress. And that's I just want to dwell on that for a minute, because I think it raises two issues. One is the issue of diagnosis of the problem, and this kind of rapid upscaling of loans suggests that the problem facing developing countries may be being treated as a short-term balance of payments problem, meaning a temporary liquidity problem. And this does really hark back to the 80s, where that debt crisis was prolonged for a very long time, precisely because of a similar erroneous judgment about the nature of the problem. And there's definitely a lot of work that's done to show, well, any kind of debt crisis will materialize or manifest as a balance payments problem, and it's very difficult to distinguish between the two. But it is just sort of echoing a point that was made earlier. The contrary to that is sort of exacerbating and delaying the recognition of a deeper problem that would need debt write-downs. The second point that I want to raise, this assessment and sort of financing going to situations of high debt risk indicates, is the confidence that we might have in these assessments. And this was a point that was made earlier, and it's made in general that the future is unknowable. DSAs rely quite heavily on the projections that are being made about the expected path of the global economy, public and private debt dynamics, and the evolution of the budget. And the two sort of main indicators that drive debt dynamics is, the growth rate and the interest rate. I just want to illustrate really some of the difficulties that are apparent in this current context. So if we can go to the next slide, and we just look at two things here. On the left is a graph of the upcoming debt redemption schedule for a number of low-income developing countries that have issued sovereign bonds recently. And there is a big repayment hump that's coming up in the next few years, which is likely to coincide both with a period that the COVID pandemic and the impacts will be more materialized and known. The low condition financing on the IMF will be probably exhausted and due. And on the right-hand side, we have a situation where the financial turbulence of recent times have sent a lot of those spreads sort of through the roof. And that market disruption that's being caused just points to the question of what kind of assumptions would be made about the sort of conditions in the markets that might be available to countries when those debt repayments come due. What assumptions would be made on the interest rate? What would be the relevant one? Which countries will have access and with what terms? This is the sort of tea leaf, or if you're from the Mediterranean, coffee reading sort of side of the exercise. And if you go to the next slide as well, there's a sort of similar thing going on with the growth rate. On the left-hand side, I just took as an illustration from some of the latest DSAs, the growth projections that are being assumed to yield the risk of debt distress that we saw earlier. And they show a very strong V shape, and even, Ethiopia here, the next year does go up again to pre-crisis growth rate. And that is quite similar to a consensus forecast. It's very similar to what the Bank of England and other institutions are projecting, is this V shape. So there is a generalizability about sort of the view in general at the moment that the crisis will produce a V-shaped recovery. But again, if we look at the right-hand side, there is a sort of all too familiar sinking feeling about how actual performance of GDP is in the context of a very deep crisis, and how that performs with projections. So if we can also go to the next slide. This also has to do with the fiscal assumption, which is very important, both in how program design is happening, and I'm very curious, very interested to hear Dalia kind of cover some of these issues. But the fiscal balances have been projected to contract dramatically in low-income countries, deficits of almost minus 6% planned. And in these DSAs, the projected consolidation is quite great. It's going to take place over the next few years. And so sort of putting those things together, one can really wonder, not just that consolidation is ineffective in the best of time for dealing with debt problems, but how this plays out in the context of a very underfunded and weak public healthcare system after decades of mandated reforms. And this sort of very sharp cost between curtailing development programs, which is already evident in the DSAs with the identification of non-priority investment projects that will be sidelined in order to make way for dealing with COVID. So if you can go to the next slide, just a little summary. If we can go to the next slide. So I'm going to go through these quickly because I realize I'm taking up a bit more time than I hoped. The things that we don't know that are undermine the ability of assessments include the path of the pandemic, the depth of the global slump, the path of these future variables, and the conditions in the financial markets. So if we, that's okay, if we can just go to the next slide. Some of the proposals that have come out in the literature about what to do about these uncertainties. One is that came out by Gelpen, Hagen, and Mazzare. They recommend patience to allow for a more fully informed assessment. And that is conditioned on a creditor standstill that includes all creditors. Rediker and Kreber-Rediker suggest a sort of similar concern about baptizing sustainable when we don't know. And they're saying why couldn't non-upper credit tranche programs progress without needing the strict sustainability requirements? And that kind of reminds me a little bit of what's going on in the private finance sector at the moment with the European Banking Authority kind of stopping stress testing of banks, capital requirements are being relaxed, and a sort of similar call for patience. And if we go to the next slide. Again, across the UN, so in recent reports from the Secretary General, UN DSA and Unctad, there is a sense of a convergence on the need for a comprehensive debt standstill across creditors in order to be able to have a comprehensive assessment after this immediate shock. And in terms of how to assess the size of relief that will be needed in order to sort of attain that sustainability target, the issue that Daniel put on the table is very much at the fore, which is the cost of SDG financing has to be incorporated in the financing gaps that the DSAs sort of discuss. And if we can go to the next slide. So I want to just highlight some of the things from history that could help us see, both in terms of like where did the DSA come from and its sort of position as a tool in the global architecture of resolving debt crises. The first is in its many incarnations. If we think about the latest template, the MAC framework that was introduced in the early 2000s, the objective was to introduce a standardized framework that could enable cross-country comparisons. And that very much came about out of a lot of policy failures where large loans were made on the basis of very like whimsical kind of projections. So the IMF introduced, reconfigured how countries could gain access to extraordinarily large loans and made that conditional on a rigorous assessment of sustainability. So that's kind of really important to understand that the DSA serves lenders as a guide to help them allocate funds, and that's quite different to perhaps some of the other objectives that were discussed as desirable previously. If we go to the next slide, and I am wrapping up. The other thing is that kind of harking back to the tea leaf and the sort of state of the art, that it is actually a very difficult exercise. Even when the template was introduced, this is based on archival research that I've done from the executive board. They were very dubious. The executive board was quite dubious about the concept and the template. It is imprecise, it's theoretically clear, but practically ambiguous. And the template itself is just not a breakthrough of mythical proportions, but it lays out the calculus at the center of what the DSA tool is, which is this cost. How do we address debt issues? Is it through primary adjustment, or is it through evaluating those costs of bringing down the debt through a debt restructuring? And if we can move on to the next slide. The other thing was that as part of that discussion, the DSA had been discussed at the same time in the context of an institutional statutory mechanism, which could have been used as a trigger for that mechanism to take hold. and indeed some of those discussions, again, whatever is in quotes is from the board meetings, the DSA could help activate the SDRM, and it could define the need and scope for PSI. Again, we have sort of some of the kind of quotes indicate, yeah, that there is a really important judgment that's being placed on how DSAs can help pivot towards restructuring or not, or conceal, and that became very obvious once the idea of a sort of statutory mechanism was dropped, but the life of the DSA has continued, and its malleability and pliability in political context has been, you know, greatly revealed ever since. So yeah, I just want to end on the thought that tying in sort of more appropriate DSAs with how with the international debt architecture is sort of really important. And yeah, there is no shortage of recognition, especially in the current time, of yeah, how flawed and lacking that architecture still is. And so thank you very much. I've got a thank you slide if you want to end with that, but that's okay. That's it, thanks.
Thanks so much, Christina. That was really insightful. I think Dalia will, from the IMF, will now share with us a little bit more on exactly those challenges to implementing the debt sustainability framework in the current context. So over to you, Dalia.
Thank you, Mark. I'm just going to try to turn on my video. Could you please, I think I need your help with that.
Yolanda, would you be able to?
Okay. I've put on the slides. Can you see them?
No. I'm trying to switch on your video, but no, we can't. We can't.
I'm afraid for the video, it has to be you switching it on.
Okay, I think I've done it.
And you should be able to share your screen independently.
Yes. Okay. Can you see it now?
No, we lost your video again.
Oh, okay.
It came on briefly.
Is it on now?
No.
Okay, let me try one more time.
There, yeah.
It looks like it's on.
Yeah.
Okay, I'm going to try to share my screen so that you can see the PowerPoint. Okay, can you see the PowerPoint?
No, I'm afraid we lost the video and we can't see the PowerPoint either.
Oh, okay. Well, would you like to put the PowerPoint on your side in that case?
No problem.
I did turn it all on, so I have the video on. I'll try one more time.
Yeah, your video is on now.
Okay.
That's it. Great.
Okay, and I'm just going to put the PowerPoint. Can you see it?
Yeah, we can see this.
Okay,
now.
Perfect. Thank you. All right. Well, thank you once again for inviting me to speak on this topic that's central to the work of the IMF. The objective of the debt sustainability framework is to support efforts by low-income countries to achieve their development goals while minimizing the risk that they experience debt distress. So for those of you who are not familiar with the LIC DSF, this architecture was established in 2005. It has evolved over time to remain appropriate for the rapidly changing financing landscape facing LICs and to further improve the insights provided into debt vulnerabilities. A review of the framework was undertaken in 2017. The new framework pays a lot more attention to country-specific features to make the assessment of debt sustainability. and this framework has been in use since July 2018. So let me begin by giving you a brief overview of the basic architecture of the LIC DSF. I know that Daniel touched on this earlier, so I'll try to be brief. The analysis relies on a baseline macroeconomic framework and projections of debt and debt service indicators. Based on country-specific features, a country's debt carrying capacity is established, which determines the thresholds against which the debt burden and debt service indicators are compared. There are 4 indicators that are used to determine if debt is sustainable and which are compared with the thresholds. If a country has a breach of any one of these indicators under the baseline projections, the country is assessed at high risk of debt distress. If there are no breaches of the thresholds under the baseline, but only under stress tests or shocks, the country is assessed at moderate risk of debt distress. And if there are no breaches under the baseline or stress tests, the country is assessed at low risk of debt distress. The LIC DSF pays a lot of attention to country-specific characteristics. So, for example, the indicator of debt carrying capacity takes into account country-specific factors such as the country's growth, level of reserves, remittances, and the institutional capacity to carry debt. The framework has a set of realism tools that allow the user to scrutinize the baseline projections. The new framework also includes 4 additional stress tests which capture country-specific risks. There is a contingent liability stress test that can capture the effect of liabilities from PPPs, and that's not included in the headline public debt stock. There's also a commodity price shock, a natural disaster shock, and a market financing shock. These are applied depending on their relevance for the country. In addition, we're able to combine the risk signals that come from the framework with judgment to determine the final risk rating of external debt distress. So the DSA is used for a number of things. It's integrated in our policy advice, and also, more importantly, it's used to allow debtor countries to assess their debt risk and to guide their fiscal policy and borrowing decisions. It can also be used by creditors to make their lending decisions based on their own principles. The objective of the new LIC DSF is for the DSA to be based on near complete coverage of public and publicly guaranteed debt. This is important to accurately monitor debt developments in a country and to assess its debt risks, as well as for there to be comparability across countries. The new LIC DSF also tries to give more granularity in its assessment for countries at moderate risk of debt distress, and characterizes countries at moderate risk of debt distress as having limited space to absorb shocks, moderate space to absorb shocks, or substantial space to absorb shocks. So what is debt sustainability and why is it required for IMF programs? So the LIC DSF is used to assess debt sustainability. In general, a country can be regarded, country's debt is considered sustainable when there's a high likelihood that the country will be able to meet all its current and future obligations without exceptional external financing or going into default. If a country gets into an unsustainable situation and the country has to get debt relief or defaults, this can be costly for everyone. It can be costly for debtors. Recent research has shown that defaults can lead to declines in growth and investment. Defaults can also cause borrowing countries to lose market access and suffer higher borrowing costs. It's also costly for the creditors who have to take a cut on their loans and investments. Creditors can also get mired in negotiations with both the debtor and other creditors. And creditors, they need to find a way to negotiate. Creditors and debtors need to find a way to negotiate. And the creditors in particular also need to find a way to effectively coordinate with each other. The IMF can only lend into a sustainable debt situation. This is a key requirement for IMF lending. The objective of an IMF program is to resolve a country's balance of payments problem and to restore its medium-term external viability. Debt sustainability also provides safeguards that the fund will be repaid, which will also safeguard its financial model and balance sheet. It is not our money. It is the money of the member countries of the IMF that is temporarily lent out to a country that is facing difficulties. The fund's LIC DSF framework is used to determine whether the sustainability requirement is fulfilled for low-income countries. When a country's public debt is considered unsustainable, there are typically three main options to restore sustainability. The first option is to undertake stronger fiscal adjustment. This reduces fiscal deficits and borrowing needs. We need to examine whether the fiscal adjustment that is envisaged can viably restore debt sustainability. We also need to examine if a larger fiscal adjustment to contain debt is politically feasible and socially acceptable and consistent with preserving growth at a satisfactory level while making adequate progress toward the authority's development goals. The LIC DSF has realism tools to assess the realism of planned fiscal adjustment and its impact on growth through fiscal multipliers. Another way to get more growth out of less spending is by prioritizing investment projects. A recent IMF report looked at a wide sample of countries and showed that moving from the lowest to the highest public investment efficiency quartile could double the impact of investment on output. A second option that's available to countries to restore debt sustainability, if fiscal adjustment alone is not sufficient, is for the country to seek new financing from official creditors. This can be in the form of new budget support grants, which don't create new debt obligations. Alternatively, they can seek new concessional loans, which can reduce interest costs and the present value of debt and spread repayment over a manageable period. When other options to restore debt sustainability are exhausted, there may be no alternative but to consider a debt restructuring. The appropriate design of a debt restructuring depends on the nature of the sustainability problem. The debt restructuring must address the underlying debt issues. And debt restructurings often include a combination of elements. They can include maturity extensions, which help reduce the immediate debt service burden, or an interest rate reduction, which reduces the debt service burden and improves long-term debt dynamics. They can also include principal haircuts and debt write-offs. When it comes to restructurings, the experience suggests that it's important to avoid doing too little too late. Restructurings are costly and painful. Doing it in a piecemeal way risks the need for repeat debt operations, which add to reputational costs and can have adverse effects on growth and investment. The LIC DSF is used to guide the restructuring. For debt to be considered sustainable, typically we would expect all the debt indicators to be below or close to the DSA thresholds beyond a medium-term horizon of 4 to 5 years. The decision to restructure is the decision of the member country. Once the decision to restructure is made, and if requested, the IMF's primary role is to support the authorities in setting achievable macroeconomic financing and policy parameters that would be adequate to restore debt sustainability in the medium term. This is usually in the context of an IMF program. A key challenge that is now facing LICs is that their creditor base has become increasingly more diverse and they're increasingly relying on more complex financing instruments. The availability of external financing, including from new creditors, is allowing public investment to accelerate in many countries. On the one hand, this is a positive development that's important to help lower income economies work toward achieving their SDGs. On the other hand, as highlighted in our in a January 2020 paper that was prepared jointly with the World Bank, the more complex financing landscape adds to the public debt vulnerabilities. Recent experience indicates that the increasingly diverse creditor base and types of instruments, debt instruments, can complicate and lengthen the process of debt restructuring where such restructuring is needed. The modalities for creditors that are, for example, not part of the Paris Club process to coordinate on debt resolution needs to be worked out. So here, let's take a look at the example of Chad. It required a restructuring of commercial debt to restore debt sustainability in 2018. This was done in the context of a comprehensive IMF-supported program. And the figures here are shown here are from the first program review. Thanks to the debt restructuring, the present value of debt declines. This is the chart on the left-hand side. Before the restructuring, the debt service to revenue ratio was significantly breaching its threshold. The red line, the chart on the right-hand side, shows the threshold. The green line shows the debt service indicator after the restructuring. As you can see, it's below the threshold. The restructuring agreement included specific contingencies to help safeguard sustainability in downside scenarios and accelerate the payment of debt in the case of upside scenarios. For instance, one of the contingency mechanisms in the contract allows Chad to defer some debt service payments as the price of oil falls up to a certain limit. The black line showed the debt service if oil prices were to turn out to be lower than in the baseline by 30%. In the current context, in the current crisis context, this amended debt contract has allowed Chad to lower its debt service and has helped cushion the recent oil price decline since the COVID-19 pandemic began. However, the contingency mechanisms embedded in the debt contract could become exhausted after 2021. Let me now turn to the challenges presented by the COVID-19 pandemic. Even before the pandemic, a joint IMF and World Bank paper on the evolution of debt vulnerabilities in LICs showed that the median debt to GDP ratio in LICs has been steadily rising since 2013, along with the debt to GDP ratios in emerging markets. The rise in debt to GDP ratio since 2013 was also associated with an increase in debt vulnerabilities. At the end of 2019, half of the countries were assessed as in debt distress or at high risk of debt distress. This is the gray and red bars in the chart on the left. So far, there have been three downgrades in debt distress ratings since March or since the pandemic. And the public debt to GDP ratio for low-income countries is projected to rise further in 2020, and it's slightly higher than projected a year ago. With the large spending needs in most lower-income economies, the tension between spending for development and containing debt vulnerabilities is likely to continue. Increased spending as a result of the COVID-19 pandemic is a vital immediate priority to mitigate the health and economic effects of the crisis, but will add to the debt burden in many instances. A series of initiatives have been taken to help mitigate the negative impact of COVID-19. In April, the G20 endorsed a standstill on debt service payments of the poorest countries to help the countries cope with the impact of the COVID-19 pandemic. This will help to temporarily ease the financing constraints for LICs and free up scarce money that they can use instead to cushion the impact of the crisis. The initiative does not mean that existing debt sustainability problems in some of these countries will be resolved, but it may help in preventing that more countries fall into debt distress because of the current crisis. And it provides some more time to properly assess and address debt sustainability on a country-by-country basis. The initiative complements the increases in financing from the fund and multilateral development banks and other sources of official financing. For example, in addition to supporting the implementation of the G20 debt service suspension initiative, the IMF, which the IMF is doing together with the World Bank, the IMF has given debt relief in the context of our Catastrophe Containment and Relief Trust, the CCRT, as well as through our emergency financing facilities. We're also providing financing through our emergency financing facilities for the countries that have requested this. In addition, to illustrate that the IMF recognizes the current highly uncertain environment and outlook, the semi-annual update of countries' debt carrying capacity based on WEO projections was temporarily suspended due to the uncertainty about the outlook. Debt restructurings are not easy and they take time. In the current situation of immense uncertainty about the economic impact of the pandemic, it's very hard to assess the need for a debt restructuring. The outlook is particularly uncertain for growth, exports, and fiscal revenues. These are all key indicators for debt sustainability. So depending on the strength of the recovery, several countries may find that they need a debt restructuring to make debt sustainable. So let me end. Here are some, for your reference, here's some links to online resources on the LIC DSF that you may find useful. Thank you very much.
Thanks very much, Talia. That was a very interesting overview, and I'm sure there's a lot of interesting food for thought for many of the participants. So perhaps we'll move now to some questions that we've received from participants. I think I will just go over the questions that we've received and perhaps pose the first one to Christina in particular, because I think you raised this in your presentation, and I'll cover the other questions and then move on to the other participants, to the other panelists to indeed share your thoughts. So the first question we've received is from Mark Boland on how do you view the risks that the DSSI, so the G20 debt service suspension initiative repayment period, will coincide with the hump in Eurobond repayments in 2024 to 2025, and potentially also the rapid credit facility and rapid financing instrument repayments, so repayments of emergency IMF lending. A further question we have is, if debtor countries like Pakistan carry on the same anti-people policies after rescheduling or any other form of debt relief, how do we address it? And that's from our colleague Aftab Mughal in Pakistan. And a third question for this round from Sebastian Grund. He's asking, too little too late has been a key concern in sovereign debt restructurings. Yet as the current Argentine debt negotiations highlight, even the IMF declares debt unsustainable, many large private creditors seem to delay a resolution and to push for a deal that does not restore sufficient sustainability. Do we need other additional tools than collective action clauses in sovereign bond contracts to ensure the necessary level of private sector participation? For example, standstills or changes to sovereign immunity statutes and domestic anti-holdout laws. So I'll turn first to Christina and then over to the other panelists to intervene on some of these questions.
Sorry, I was muted. Thank you very much for all the questions. I will just try to address that first one by Mark Boland. So the financing facilities of the fund, the ones which are from the general resource account, the non-concessional borrowing, so the RFI emergency is repayment schedule is 3.5 to 5 years. So that would very much coincide with the hump of the bond redemption schedule. And the DSSI terms of reference sheet for the bilateral creditors is also a year of grace and then repayment within 3 years. So very much coming over that kind of 2023, very difficult moment of refinancing. For the RCF, Dalia, please jump in here if, just to sort of add stuff, but the repayment schedule is up to 10 years. So for low income, for LIC countries that have a hump, that might, the IMF financing might not directly coincide. But in any case, I think your question is spot on in the sense that we should really be trying to figure out how these initiatives that are being implemented, both the new loans and the repayment schedule, and the bilateral initiative, including the private sector term of reference sheet, which actually increases the interest cost burden. You're paying interest on interest deferred, and how that would actually affect a repayment capacity in the future. So yeah, that's definitely something to look out for. I haven't done a calculation myself, but it would be interesting to know if and how the IMF is making those assessments based on these developments, sort of as it happens. And I wasn't sure if you. Yeah, I'll pause here, but I would come back to one of the other questions later on.
Thanks, Christina. Yeah, I realized my moderation was a bit confusing for you there. Well, perhaps we'll move to Dalia, and you can address indeed the same question on the potential risks that are coming up mid-decade, and also some of the other questions that have been raised.
Okay, thank you. Perhaps I could just add that in many of the country teams assume that by 2024, it's true that there is a repayment, there is a hump in repayments in 2024, but it's reasonable to assume that market access to markets, that the crisis will be over, and that countries will regain access to markets by then. And I think this also emphasizes the importance for countries to have to strengthen their debt management capacity and generally, so that they can address these the needs for, they can prepare for the potential need for higher redemptions in the medium to long term. So this, so they can try to address it in advance, and including through official support. Of course, if a country, the debt is seen as unsustainable, then there may be a need for more comprehensive approach, potentially through restructuring. So this, I think, addresses the first question. With regard to the third question, in terms of the tools that are needed to ensure private sector participation, it's true the IMF has helped promote the adoption of collective action clauses in international bond contracts to facilitate debt restructuring in circumstances where there are some holdout creditors seeking favorable treatment. But of course, this is the resolution of debt distress is still can be challenging given the diversity of creditors and debt instruments. And this may call for further architectural reforms where the IMF can help contribute to. I think that's on my side. I think I'll stop here. Thank you.
And Daniel, would you like to come in on this first round of questions?
Yeah, so regarding the second question, what options do developing countries have if they continue carrying policies of basically pro-cyclical adjustment in the face of the pandemic? I think that's also connected with a bit with the third question, because basically what we have seen so far is that the approach taken by the G20 in addressing the issue of private creditor involvement, which is fundamental given their participation of around 30% in the case of low-income countries, 30% meaning the participation in debt service, that raises all the way to 85% of that service in the case of middle income countries. We already tried, the G20 already tried asking nicely to participate. And as Lee Buchheit and the Bolton Committee have highlighted, this is a bit of a teachable moment in the sense that we ask nicely and basically no action, no real concrete and meaningful action has come forward from private creditors to provide that relief in order to free up resources to tackle the recovery process. And what we're seeing is, for example, it's very interesting, and we have the example of Argentina, but also more recently, just this week of Ecuador, where there is an agreement of principle between the country and its creditors. But what we see, it's basically a deal that there is a haircut on the private creditor claims of around 70% of net present value, assuming a 10% exit yield. The problem with this sort of agreement is that it seems that private creditors are willing to agree, but on conditions that not necessarily ensure debt sustainability of the country that is negotiating with them. And at Eurodad, in order to address these issues, we developed a proposal alongside with Gregory Pustovich to use the Article 8 of the IMF. We basically built on a proposal that was initially put forward in 1984, that use of Article 8 of the IMF will allow to create an automatic debt standstill on countries that are receiving support from the IMF to ensure that its private creditors cannot initiate legal actions against these countries. This would require a change in the, or not a change, but the introduction of a definition of several items in the Article 8 language. But through this sort of mechanism, we can ensure that private creditors participate and contribute to debt relief on a basis that countries can free up enough resources to meet its claims. Because the problem that we are facing right now, and the risk that we're facing right now, is that the basic assumption of the UN and other multilateral agencies is that in April, when the first set of assessments came of the impact of COVID, was that we're going to have a V-shaped recovery. But what we're starting to see, for example, seeing a second wave, mostly in the US, but also on the growing impact that COVID is having in developing countries, that this crisis might take much longer and have a much larger economic impact. So it's actually becoming quite clear that this is not a liquidity issue, that it's a solvency issue. And the more we delay providing substantial support to these countries, we're going to have a situation where an economic crisis is eventually going to transform into a humanitarian crisis in the first hand, and a political crisis, where you're going to start seeing a massive backlash against pro-cyclical policies of adjustment.
Thanks to all of you. I'll encourage the attendees to pose any further questions they may have. I'd like to potentially ask Dalia, where you mentioned a little bit on on the natural disaster stress test that is built into the current LIC DSF framework. As we're facing the challenges of climate change and exogenous shocks are becoming, we can expect them to increase in intensity and frequency. It would be interesting to hear from you more about how the IMF is looking at integrating climate vulnerabilities into the LIC DSF, something that many constituencies are calling for increasingly, and something that we see the real relevance of, particularly looking at the dynamics of this current crisis. I'll open to Christina and Daniel after if they also want to step in on this. Dalia.
Okay. Sorry. Yeah. So maybe just in terms of the low-income country DSF recognizes that some countries are susceptible to climate shocks. So when we are doing that sustainability assessment, there's a careful check of the factors that are relevant for the risk assessment, and that these are properly accounted for. So for example, the DSA allows, the framework allows country teams to use a longer time horizon to inform the risk rating beyond the standard 10 years to take into account of long-term concerns, including climate change. And then in addition, the LIC DSF has a tailored stress test, which I mentioned earlier, for countries that are exposed to natural disasters. And these tools have been applied in a number of fragile country cases. Yeah, I hope that answers your question.
Can I come back to one of those earlier questions?
Sure, go ahead.
It was to the question before last by Sebastian Grund about the sort of overarching reforms to address sort of sovereign debt difficulties. There have been a variety of proposals that are coming out precisely to address the failings of the current kind of architecture. And I think your question kind of points out to the main clusters of proposals. And I've written something which tries to summarize this, which I'll circulate shortly. But one of the way that I've kind of summarized it is the contractual innovations that are being put on the table, including sort of changing voting thresholds to prevent acceleration of clauses and things, yeah. So a variety of market-based innovations that could take place. Those have been endorsed by the Interagency Task Force as one of the things that can be done on that kind of big scale. Similarly, there's a whole variety of proposals which are about enforcing creditor participation more broadly, and that's that would come under the proposal that Daniel has been developing, which is about using existing legislation at the IMF, but also the CCF proposal by Bolton and Tal. And there's sort of like a proliferation about how broader creditors can be, how the broader creditor standstill can be implemented. Because of the sort of how prone those proposals are to litigation and resistance, there's also another cluster of proposals about national statutory legislation that could prevent creditors bringing cases to different courts. And certainly I know that the UK has been very active, not only because a lot of these bonds are under the UK legislation, but because a lot of researchers here have been trying to develop those. And Jubilee Debt Campaign has put over a suggestion to extend what had been used under the HIPIC initiative, which prevented commercial creditors from gaining their full claim. So there are lots of efforts kind of going in those directions. But I think it's really important to highlight that there's also a lot of effort going into the overarching discussion. And that's come across certainly in all of the UN reports from the Secretary General, from UN DSA, and from UNCTAD. They're working very much on the idea of like a neutral forum that can arbitrate more effectively. Because I think one of the points I was trying to raise with the history of the DSA is that the fact that it's originated as a lending decision tool that's very much about helping to guide the IMF's own decision-making process and the capacity of repayment to the fund, which is fair enough for a lending institution. But it does muddy the water in terms of neutrality when you're trying to make these very difficult decisions about debt restructurings, which is why if you look in these recent UN reports, the idea of a forum which is sort of more suited, kind of picking up this long-standing debate for an international statutory mechanism is very much at the forefront of these discussions at the moment. And there are lots of variations. Some of them are statutory. Gelper and al. Have a proposal for a forum which is not, it's mandatory and voluntary. But again, it's sort of bringing together this idea that coordination is absolutely lacking and comprehensiveness is absolutely lacking, which yields to these perverse incentives with the IMF's funds being used to bail out, you know, other creditors. Same with the DSSI official creditors as well. So that these structural problems are just very evident at the moment. And it can only be good that they're being discussed on a sort of grand scale. It's just how to make more progress on them. So yeah, I'll stop there, but thanks very much for your question.
I'm conscious that we're running very close to the end, but I'm going to give Dalia and Daniel perhaps a last word, just to touch indeed on what I was hoping we could consider at the closing of this. And Christina, you've pointed to it already. I think looking at some of the ways that some of the COVID-19 lending packages and the recourse to fiscal consolidation that it seems to suggest we can expect the IMF is pushing countries towards once the acute crisis recedes. The way lending is being pushed out, potentially bailing out reckless lending rather and contributing to this issue of too little too late that we've been talking about, postponing the potential need for an inevitable and necessary debt restructuring. In your judgment, what do you see the outlook for us departing from business as usual and actually addressing some of these more fundamental questions as we move through the response to this crisis? And I'll be very, very strict and give you 1 minute each to answer that massive question. So over to you, Dalia, to begin.
Okay. Just want to reiterate that debt restructurings are not easy, and they take time. And the current situation, the countries really need immediate debt relief, and the debt service suspension initiative helps provides this temporary, temporarily eases the financing constraints for the poorest countries and provides, frees up scarce resources that they can use to mitigate the human and economic impact of the COVID-19 crisis. Of course, it's true that the initiative doesn't mean that we'll solve the existing debt sustainability problems in some of the countries, but we're in a situation of immense uncertainty about the economic impact of the pandemic, and it's very hard to assess the need for a debt restructuring. So in this, I think this time, the debt service suspension initiative provides the resources that LICs need and the time, it buys time to properly assess and address debt sustainability on a country by country basis. So I think I'd just like to emphasize that. Yes, thank you.
Many thanks, Dalia. And last word to Daniel.
Yeah, I think the key issue here and the main concern should be that most of the people that are looking at what's happening, it has been, or it is, a big puzzle, because against all you're seeing a return of investors into sovereign debt markets in developing countries, despite that the impact of the macroeconomic shock has undermined the prospects of these countries of being able to carry the debts they have. So I think we're effectively in a situation where we kind of are aware that we're going towards massive debt crisis, and it's slowly moving. But once countries start falling into defaults, my fear is that this is going to rapidly spread, and countries that have been tapping back markets are all of a sudden going to see their access shut. So in this context, the key issue is that the more we delay taking proactive action to deal with solvency concerns of developing countries, it's effectively a missed opportunity, because more and more resources are going to be devoted to meeting claims that are effectively unsustainable. And in the meantime, the recovery is going to be weaker, and the problems of countries are going to be much harder to surmount. And I really hope that I'm wrong.
Well, unfortunately, on that rather bleak outlook, I'm afraid we're going to have to come to a close this afternoon. But I really thank the panelists for a very interesting and information-rich session. We'll be sharing the presentations and making them available along with the recording of the webinar on the Eurodad website very shortly. Please do bear with us, because we're just currently transitioning to a new website. So when you go hunting for the recordings of these videos, that'll be your first chance to explore a new website as well. But we've heard a lot about the big challenges that lie ahead. And you'll be hearing a lot more about these issues, not least in the coming week, as we anticipate the G20 finance ministers meeting next week, and there'll be a number of outputs that Christina and Daniel have alluded to, coming from Eurodad partners such as Jubilee Debt Campaign UK and others, looking at particularly how the G20 debt service suspension initiative has been operating. So with that in mind, I'll call to a close this latest series of Eurodad webinars. We hope to be picking up a lot of these questions after the summer, and we'll be working with many of you in the interim on a lot of these issues. So thanks once again to the panelists, to Christina, Daniel and Dalia. And thanks to all of you for attending. And also a special thanks to Laia and David, our interpreters, who've been working very, very hard throughout all of these webinars to ensure Spanish English interpretation, and to Yolanda and our colleague Ilaria, who's been critical in making sure everything's happening technically and logistically. So thanks very much.
Thank you. Bye.
Thank you. Bye-bye.